What if you could learn the basics of Forex trading in just one video instead of searching through dozens of videos online? If you're a complete beginner and you've always wanted to understand what Forex is, how the market works, and the key concepts every trader needs to know before risking money, then you are in the right place. Welcome. Yes, I want to specially welcome you and congratulate you for taking advantage of this opportunity of learning a high income skill that can guarantee you more money in your pocket from the comfort of your home with just your smartphone and data connection. All right, so welcome once again. My name is Rejoice Muna. I am a financial market trader and coach, and I am the creative director of FME Academy, that is Forex Made Easy Academy. And today I will be your host in this free webinar. Now, many people make it seem like Forex trading is difficult, but trust me, it is not as hard as you think. Before now, I created a beginner-friendly Forex series that breaks down trading into simple, easy to understand lessons, and in this video, I have combined all 30 lessons into one complete beginner guide so you can learn everything from start to finish without jumping between different videos. So grab a notebook and focus on this free webinar. All right? So let's get started. But before we do that, I want us to note that there is a disclaimer in this skill set called Forex trading. Now, trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. Okay, now this is the disclaimer. Let us go into the free webinar completely. Welcome to the Forex Made Easy 30-day challenge. And this is day one. And day one's topic is, what is Forex? What is Forex? Now, Forex is an abbreviation for the words foreign exchange. Now, let me break it down in a way that you would understand. Imagine you're a yam seller and you bought each yam for 1,000 naira when it was cheap. Later, the price increased to 1,500 and then you sold it. This is trading in the simplest form. You buy low, sell high, and make your profit. Now, Forex works the same way. The only difference is that instead of yams, you are buying and selling money. You are buying and selling currencies. Okay? Now, for instance, you buy $1 at 1,000 naira. Later, the price rises to 1,500 and you sell that dollar for 1,500 instead of 1,000 naira that you initially bought it, making you a profit of 500 naira. You have just been involved in the Forex market and you have gained some profit by trading the currencies. Forex is not magic. It is not gambling. It is simply buying and selling money. The same way you buy and sell rice, beans, yam in the markets. When you buy and sell money or buy and sell currencies, you have traded the Forex market. Welcome to day 2 of our Forex Made Easy 30-day challenge. And today's topic is routes to trading Forex. Okay. Now, there are 2 main ways to trade Forex. The first is buying and selling the currency itself. This is owning the currency. For example, you buy dollars at 1,000 naira. Later, the price rises to 1,005. You sell and make profits. That's holding the currency. And this is the same thing people do with stocks, crypto, or real estate. They invest, they buy and hold, hoping the value will rise. Now, for the second is the real way most traders do it. This is speculating via CFD. CFD means contracts for difference. Now, yeah, you don't need to own the dollars, stocks, or even cryptocurrency. All you need to do is to trade the price movement. You speculate on the prices of the cryptocurrency, of the currencies, of the stocks, whether it goes up or down, and then you make profits from doing so. So when people say, do you trade Forex? What they really mean is, do you trade the financial markets through CFD? Do you trade currencies, gold, stocks, crypto, indices through CFD, where you make profit from price movement? So just like our day one example where we used the yam, instead of buying the yam and waiting for the price to rise so that you sell, all you need to do is to predict whether the yam will go up so that you buy, or it will come down so that you sell, and then you make a profit from the price movements. Okay? Welcome to day 3 of our Forex Made Easy 30-day challenge. And today's topic is, where is the Forex market located? Where is the Forex market located? There is no central marketplace or exchange for the Forex trading market. Unlike stocks, where each country has a processing place, such as NYSE, that's the New York Stock Exchange in the US, or the ASX, that's the Australian Stock Exchange in Australia, or the Nigerian Stock Exchange. Forex is a truly global marketplace that is connected by large banks and their prices. Okay, so because Forex has no set marketplace or exchange, there is no official daily closing time. It is open 24 hours, 5 days a week. Although the close of the US market is generally seen worldwide as the close of the Forex market. Okay, because the highly traded currency in the Forex market is the US dollar. Okay. So let me simplify this. Just as you go to the physical market to buy your yams, for the Forex market, it's a global online market. So this is a global online market where buyers and sellers from different parts of the world trade currencies online 24 hours, 5 days a week, where all you will need is your phone, internet, and the knowledge to trade the Forex market. So if you're trading via CFD, you can trade all other parts of the financial market, the Forex market, stock market, crypto market, indices market, everything. So welcome to day 4 of our 30-day challenge. And today's topic is, who can trade Forex? The Forex market is traded by a variety of players. The market is actually moved by big players. We have the big banks or the super banks. They trade daily to manage billions in currencies. We have the government and the central banks. These ones, they trade to stabilize their economy. We have companies. Large companies trade to pay for goods across countries. Then there we are, the retail traders. So these are the ones that use their phones, laptops, trading apps, and also join to buy and sell currencies in order to make profits. So what they do is to speculate on the price movements of these currencies and try to make profits. So back to our yam illustration. For the yam illustration, let's say we have a big yam market in Nigeria, and then we have big players like the big farmers who bring in hundreds of tubers of yams every day, buying and selling in large quantity. Then we have the central banks and the government who helps to balance things. They step in to either reduce the price of yam if it's too expensive, or to stop it from going too low. And then we also have the big restaurants. These ones buy yams in bulk to cook and sell. Okay, these are the big companies. Then we also have retail sellers. That's like you and I, who maybe buy 10 tubers of yam daily to sell to make profits. So next time when you hear Forex, remember it is a real global business, not gambling. Okay? Welcome to day 5, and today's topic is, who controls the Forex market? Who controls the Forex market? Although there is no centralized exchange for the Forex market, there are lots of different structures within the Forex market that actually control the Forex prices in one way or another. Now, here is how it really works. Just like in your local yam market, the more people want to buy yam, the price goes up. The higher the demand, the higher the price. Okay? And when more people want to sell, the price goes down. So this is called supply and demand, and it is one of the biggest things that controls Forex prices. Okay? But aside supply and demand, governments and central banks also play a role. When they change interest rate or monetary policies, it affects the value of their country's currency. So, for example, if the US increases interest rates, more people will want to hold US dollars, and the demand goes up, and then dollar becomes stronger. The stronger the country's economy, the stronger the demand for that currency. Okay? So even though no one person controls Forex, the market prices moves based on supply and demand forces, central banks and government policies, and millions of traders like the big banks, the institutional traders, companies, and retail traders like you and I are buying and selling currencies every day. So we also affect the price movement. So no one person controls the forex market. It's all about supply and demand, policies, and collective buying and selling that moves price every second. Welcome to day 6, and today's topic is what are currency pairs? So with Forex, you're not trading just one currency, you're trading the value between two currencies. Now, currencies are traded in pairs. Pairs are made up of two currencies. For example, you have the Euro USD, EUR USD, which is the Euro and the US dollar. When you buy the Euro USD, you are buying the Euro and selling US dollars. If you're buying this Euro and selling US dollar, you think that the Euro is strong compared to the US dollar. So if you were to enter a trade on the Euro USD pair, you're of the thought that the Euro is strong compared to the US dollar. All right. And if you were to also enter a trade thinking that the Euro is weak compared to the US dollar, you would sell that trade. You will go short. So this is just how the forex market works. This is how all forex pairs work. You're trading on the assumption that one side of the pair is stronger or weaker than the other side of the pair. Let's take another example, GBP USD. So if you think that the British pound will strengthen more than the US dollar, then you should buy the currency pair GBP USD. But if you think the US dollar will strengthen, then you should sell the currency pair GBP USD. Welcome to day 7, and today's topic is what is base and quote currency? Just as you have on your screen here, the Euro USD. The first currency listed in any currency pair is called the base currency. In our case, it's the euro. While the second currency to the right of the slash is called the quote currency, the quote or the counter currency, the quote currency. And in our case, it's USD. Okay, so when the buying and selling in the forex market occur, the base currency is always the currency of reference. In our case here, we are buying Euro USD. This implies that we are buying the base currency, which is the euro. All right. Let me come down to our Nigerian setting. For instance, you want to buy USD with Naira. You want to buy US dollar with Naira. Okay. So if you're buying US dollar, you are buying the base currency. All right, and you will need Naira to buy the base currency. Okay. Welcome to day 8, and today's topic is how to read a forex quote. Let's still continue with this example, Euro USD. If the Euro USD exchange rate is trading at, let's say, 1.1500, this means that it will cost you 1.1500 US dollars in order to purchase 1 unit of euro. Okay, the first listed currency, which is the base currency now, is our case study, and this is euro. Okay, you are using the quote currency to buy the base currency. I don't know if that makes sense. Okay, if the exchange rate says Euro USD is 1.1500, this means that it will cost you 1.1500 US dollar to buy 1 euro. Okay, let's go back to the yam illustration. If the quote for buying yam is yam slash NGN equals to 1,000 naira, this means that you would need 1,000 naira to buy 1 yam. Okay, that is how to read a quote. Even in cryptocurrency, if you have BTC slash US dollar and the BTC slash US dollar is equals to $100,000, this means that you would need $100,000 to buy 1 BTC. Okay. Welcome to day 9, and today's topic is who is a forex broker? A forex broker is a middleman that connects you to the global forex market. Okay, let me give you an illustration. You know, when you want to change naira to dollars, you don't just walk into the central bank. you need to go to the bureau de change, an exchanger. These are bookie people that can help you change your money. So these are the middlemen that connects you that want to buy or sell to someone who wants to sell or buy. Okay, that's exactly what a forex broker does in the online forex market. Now, in the online forex market, you need to open an account with a forex broker. They will help you to connect you to the global forex market where currencies are being bought and sold 24 hours a day. Without the broker, you cannot access the market. So when you log in or sign up with the broker gives you your details to be able to access the trading platforms like their apps, MetaTrader 5, MetaTrader 4, where you buy and sell currencies easily. And the best part is that you can do this from your phone, your laptop. You don't need to visit any office or bureau de change. So a broker simply helps you trade from your home to the world. Welcome to day 10, and today's topic is Forex Terminologies Part 1. Forex Terminologies. We're treating some of the Forex Terminologies. Just as you have on your screen, the first one we'll be talking about is long or short. When trading Forex, you have two options. You can either enter a long position, which means that you're buying, or a short position, which is selling. The easiest way to remember it is like this: long, buy; short, sell. The second terminology is the bulls and the bears. A bear market is typically considered to exist when there has been a price decline, when the price is decreasing, while a bullish market or a bull market is considered when there is a price increase, when price is increasing. In an uptrend, the market is bullish, the price is increasing, and what do? You go long. You take a long position, which means you buy. But in a downtrend, the market is bearish. That means the market is decreasing or declining, and that means you go short. You take a short position, you sell. Bull, increase; long, buy. Bear, decrease; short, sell. Okay? Welcome to day 11, and today's topic is Forex Terminologies Part 2. So we're going to continue with the Forex terminology. Bid and ask. What do we mean by bid and ask? When looking to take a trade on the Forex pair, the trader will be quoted two prices. These prices are known as the bid and ask price. Just as you see it on your screen, the bid price is the current price you can sell this pair. You can see this price on the left of your order ticket. Okay, now what is the ask price? The ask price is the current price on offer to buy this pair from the market. The current price to buy this pair from the market. Okay, and this is by the right hand side of your order ticket. So the difference between these two prices is what we call the spread. That takes me to explaining the terminology spread. From the picture you're seeing on your screen, you will notice that there's a margin in between the bid and the ask price. This gap in price is known as the spread. On every round trade you make, you will pay the spread. The spread is how the brokers make money. The spread is how the brokers make their own profits from traders making trades. Okay, let's bring it down to the Nigerian setting. If you want to change your dollar to naira and you want to meet like the bookie men that do this exchange, just as we spoke in day 9 about the forex broker. Okay, now the average rate of the USD NGN will be probably 1,500. Then if you want to buy dollar with your naira, the Aboki man will sell the dollar for you at 1,600. But if you want to sell your dollar for naira, the Aboki man will buy from you at 1,400. So the Aboki man, he buys your dollar for 1,400 and then he sells to you at 1,600. So this is the bid and the ask price. And the difference in these prices is what we call the spread. This is how the brokers make their money. Okay? Welcome to day 12. And today's topic is what is leverage? Leverage is simply anything you can use that gives you the power to use something small to control something big. Okay? It just gives you the power to use something small to control something big. Now, let me explain further. Leverage works by letting traders enter into trades with only a fraction of the money down. In forex trading, traders can use leverage to enter trades while only paying a small amount upfront. Now, the most common leverage amount is 100:1. This means that for every $100 traded, the trader only needs to front up $1 to enter that trade. And that's why sometimes you can use $100 or $500 in your trading account and make as much as $2,500. Do you understand? Because of leverage in CFD, leverage in CFD. Let me bring this back in the yam illustration. Let's say you have 100,000 naira in your bank account, but then you need 10,000 naira out of that 100,000 naira to buy yams. Let's say one yam is for 1,000 naira. So you're hoping that the price will rise to 1,005 and then you make at least a profit of 500 naira per yam. Now you have only 10,000 naira. That's enough to buy just 10 yams. But your supplier says, no problem, bring 10,000 naira and carry 100 yams. So this is like a leverage of 1:10. Bring 10,000 naira and carry 100 yams. You pay me the remaining 90,000 naira later after your sale. That's leverage in action. You're controlling a bigger number of yams with a smaller amount of your own money. Okay, now if the price of yam rises to 1,500 and you sell all 100 yams, you would have gotten 150,000. So from the 150,000 naira, you give her back her 90,000 naira, and then you have 60,000 naira to put back into your bank that is remaining 90,000 to make it 150,000 naira. So your money moved from 100,000 naira in your bank account before the yam sale to 150,000 naira after the yam sale. Now, leverage can be a good tool and it can also be a dangerous tool. Assuming the trade didn't move in your favor, like if the price of yam dropped to 500 naira per yam and you're able to sell the 100 for only 50,000 naira, this means that you give your supplier the 50,000 naira and then still go back to give him extra 40,000 naira from that your 90,000 naira that is in your bank account. So that means you have the money you have left in your bank account will be 50,000 naira, meaning you lost 50,000 naira from that trade. So you were having 100,000 naira before the yam sale, but after the yam sale, you had 50,000 naira left. That is what leverage can do. Welcome to day 13, and today's topic is, what is margin? Margin. Now, margin goes hand in hand with leverage. Margin is the amount your broker asks you to place upfront for any trade you are in. The amount of margin required by the broker will depend on both the size of the trade and how much leverage is being used. So if you're using 100:1 leverage, the broker will require you $1 for every $100 you have in an open trade. This is what margin is all about. So using our illustration of day 12, how your supplier lets you take 100,000 naira worth of yams while paid only 10,000 naira upfront. That 10,000 naira you paid upfront, that's called your margin. Margin is simply the amount of money you deposit to open a trade. Okay? Welcome to day 14, and today's topic is, what is a lot? Now, a lot simply refers to how much of a currency a trader is trading. Okay? Now, when trading Forex, traders enter what is called a lot. Instead of buying massive amounts of an individual currency pair, a trader enters the amount of lots that is suitable. Okay? I will explain further. There are three main types of lot sizes, which are micro, mini, and standard. Your lot size will affect your margin. Okay? For instance, when we discussed leverage and margin, that we said 100:1. If you want to take a trade of $100, you will need to put upfront $1. Now, that is based on the micro lot size 0.01. Okay, it's based on the micro lot size 0.01. If you increase your lot size to 0.02, what this means is that you're going to put upfront $2, and this means that you intend to take a trade of $200. So that means your leverage is still 1:100, but your margin is $2 and your trade is $200. So that 0.02 lot size has affected your margin and has increased it from $1 to $2. Now you are putting $2 upfront in order to get $200. So back to our yam example of 1:10 leverage, where you are to pay 10,000 naira upfront for a 100,000 naira yam trade, that is 100 yams. If you increase your lot size to 0.02, this will require you to pay 20,000 naira upfront for a 200,000 naira yam trade, that is for 200 yams. Welcome to day 15, and today's topic is, what is a PEEP? A PEEP is the smallest increment a currency pair can move. Now, each currency pair is normally quoted in either 4 or 5 decimals. And in the case of some Japanese yen pairs, they are normally quoted in either 2 or 3 decimals. Now, when trading, we use the amount of pips to work out things like our entry when we're going to enter a trade, for our stop loss. When we delve into types of orders, you understand more, for our targets, where we want to get to, where we want to close that trade, as well as things like the profit made and the amount of risks we want to take. Now, let me give us an example of a PEEP. If the Euro USD exchange rate moves from 1.1500 to 1.1501, it just moved from 1.1500 to 1.1501. That's 0.0001 move represents 1 PEEP change in price. Okay, that 0.0001 move represents 1 PEEP change in price. Using the yam illustration, let's say yesterday you went to the market to buy yam and it was 1,000 naira. And today you came back to buy again and you were told that the price has increased from 1,000 naira to 1,010 naira. That 10 naira difference is 10 pips increment. That is how much of price movement that the price has moved from 1,000 naira to 1,010 naira. Welcome to day 16, and today's topic is Market Orders Part 1. We'll be discussing some parts of the market orders in today's video.
There are different orders in the Forex market. It's called Forex market orders or Forex orders. Now, number one, we have instant or immediate execution. That's market execution. This instant execution is just buy or sell execution. It means that you are ordering for immediate execution at the price it is at the moment. You're placing your order at the price it is at the moment, at the current price. So that is what is called instant execution. So we have pending orders. This include buy stop, sell stop, buy limit, sell limit orders. Now, what is a buy stop order? A buy stop order is when you place an order that is above the current price, when you believe that the market will continue to rise. Do you understand? You believe that the market will continue to rise. You say, okay, I think this market will continue to rise. Let me put a pending order. Pick me up when you get to this. When it gets to this price, pick me up. Then I believe it will continue to rise, and now it will continue to rise, and I'll follow the market and benefit. So it's an order placed above price when you believe that the market will continue to rise. Do you understand? What is sell stop? Sell stop is also the same thing, but this is when you place a sell order below price when you believe that the market will continue to fall. Probably the price is at 100. You know that it's going to drop to 20. You say, okay, pick me up when it gets to 80. When it gets to 80, pick me up. Then I'm sure that this market is really, really selling. Then I will take my profit. Do you understand? So that is buy stop and sell stop.
Now, using our yam illustration, let's say you've noticed that each time yam price goes above 1,000 naira, that it will continue to rise fast. As in, you are in the market, this is what you have noticed. So, and you now notice that yam price is about to like increase from that 1,000 naira. So you're just waiting for the market to give you the signal, and then you tell your supplier that once this thing gets to 1,001, take my money and buy for me. Oh, this means that price will continue to rise and it might even get to 1,003, 1,004. So take my 10,000 naira or 20,000 naira and buy as much yam as you can buy at 1,001 for me. Okay, this is a buy stop order because you believe that the price will continue to rise, and if it crosses like that limit, it rises above a particular limit of 1,000 naira, that means it has a higher chance of going up. So you can buy above that 1,000 naira with hope that it will continue rising to probably 1,003, 1,004, 1,005. This is a buy stop order. Welcome to day 17, and today's topic is market orders part 2. And today we'll be discussing buy limit and sell limit.
Now, what is buy limit? Buy limit is when you place an order below price, when you believe the market will go back up. Do you understand? I personally, I love to use buy limit. Probably the price is, I know that this market is going to buy, and I know that it will still come down a bit before before it continues rising. So I might place buy limit. Okay. So when you drop a little, pick me up, then continue your rise. That's buy limit. When you drop a little, pick me up and pick my order and continue your rise up. Do you understand? It's another place below price when you believe the market will continue to go up, will go up, or will go back up. Same thing with sell limit order is another placed above price when you believe that the market will go back down. Do you understand? You know that this market is going to sell, but you said maybe to go a little bit up and then start going down again. So you say, okay, let me to benefit more. Pick me up when it goes up a bit and then continue to go down. That is sell limit order.
Using our yam illustration, let's say yam price is 1,000 naira right now, and you believe that this will go up to like 1,500 later. But before that, you expect some sellers to probably sell as 800, or you expect price to drop at least to 800 before bouncing back up. So you tell your friend in the market, if the yam price drops to 800, buy for me automatically. This is a buy limit order. You are buying below the current price because you believe it will drop first, then rise again. It's like saying, let price fall a bit so I can buy cheaper before it goes back up. So this is a buy limit order, and the vice versa is for sell limits. Welcome to day 18, and today's topic is market orders part 3. So we'll be discussing stop loss orders and take profits.
Stop loss order and take profit order. Stop loss order is very, very, very good. It's very good so that it helps you to minimize your losses so that you don't lose your capital, you don't lose all your money. You might say, I don't need to put a stop loss. What if the market start going back up, or what if the market starts selling and hit my stop loss and take me out? It's better it takes you out on minimal loss than for it to blow up your account because you did not put a stop loss. So in order to avoid more losses, always put a stop loss. Always put a stop loss. Now, for a buy order, a stop loss is when you place stop loss beneath your entry price. When you place stop loss beneath your entry price, do you understand? So that in case the market goes down against you, not in your favor, it didn't buy again, it will take you out of the market, but at least it will take you out on a minimal loss instead of it to blow up your account. That's why stop loss is very necessary. Same thing with sell order. When you place a stop loss in a sell order, you put it above the entry price. Above the entry price, instead of the market to start going down, it now goes against you and start going up. It will hit your stop loss and take you out of the market instead of it blowing up your whole account. So you see why stop loss is very, very necessary. Now, this stop loss order is a protective order. It's designed to limit your losses if price moves against you. So it's very necessary you use it. Another one is take profit order. Take profit order is an order designed to lock in your profit at a desired market price. Whether the market continue to go up again, it doesn't concern you. The market will just take you out of the market. The order will take you out of the market after your profit has been locked. Do you understand? Take profit is also good. You put a take profit order, you say, okay, when you reach this place, I'm okay. I'm okay with my profit. Take me out of the market. Even if it continues to yield more profit, I don't want to know. Take me out of the market when it gets to this, my desired take profit. So that is a take profit order. So for a buy order, your take profit will be above your entry price. You are believing it will go up now, so you put the take profit above your entry price, maybe 50 pips. When it gives me 50 pips profit, take me out. In a sell order, your take profit will be below the entry price. When it gives me maybe 50 pips profit, take me out. So these are the orders in Forex. These are the orders in Forex.
Welcome to day 19, and today's topic is MT4, MT5, and demo accounts. You can't trade Forex without having access to the platform that connects you to the markets. Examples of these platforms are MetaTrader 4, MT4, MetaTrader 5, MT5, where you can be able to see live price charts and place buy or sell orders. So today we'll be teaching you how to install your trading platform, which is the MT4. So you go to your Play Store if you're using Android, or your iOS App Store if you're using Apple, iPhone. Then you click on the search bar. Then you type MetaTrader, either MetaTrader 4 or MetaTrader 5, whichever one you want. You install it. Because I already have it installed on my phone, so I don't need to install it again. But if you don't have it installed on your phone, you would have to click the install. MetaTrader 5 is like better than MT4. It has more options and more advanced, settings than the MT4. So you could go for MT5. It's really almost the same thing, but this one has a better interface. So you can click on the MetaTrader 5 and then you click on install. Then once you have it installed in your phone, you can now create your demo account. By now you must have downloaded and installed your MT4. You need to be signed up with a broker before you can use your MT4 platform. So a demo account is a type of account offered by trading platforms that allows a prospective customer to experiment with the trading platform before putting in real money. So a demo account is like the account you're going to use to practice, your strategies before putting in real money, before opening a live account. Welcome to day 20, and today we're going to be discussing trading sessions.
Now, as we all know that the Forex market is open 24 hours a day and for 5 days in a week. So you could, in a way, say that the Forex market never sleeps. But just as the market is open, there are times during the day when you place your trade and make profits. You're supposed to trade when there is volume and volatility, when there is price movement in the market, and the Forex trading time has been divided into different sessions. There are times during the day when the currency prices are trending, but there are times when they are quiet as well. So you need price movement and trend to provide you with opportunity to make profit in the Forex market.
There are 3 major Forex trading sessions, and they are:
1, the Asian session; 2, the London session; and 3, the New York session. Okay, the Asian session is a combination of Sydney and Tokyo session, the London session or European session, and then we have the New York session. The London session is open from 8 a.m. Nigerian time to 5 p.m. Now, the New York session opens at 2 p.m. Nigerian time. So when the New York session opens, the London session is in progress, but it's almost about to close. Do you understand? There's an overlap of 3 hours between the London and the New York session. And this, when 2 sessions are simultaneously open and overlap, they even give you a higher volume and the higher price movement in the market. So this is because participants from both time zones are placing their buy and sell orders. So hence the changes in price are visible in the market during sessions with high trading volumes. So as a Nigerian trader, it's better you trade during the London session, that is 8 a.m. to 5 p.m. Okay?
Even if you're not a Nigerian trader, whichever country you reside or whichever country you come from, you just check when there's an overlap in the trading sessions, and that will be the best time for you to trade. So when there's an overlap between the London and the New York session, or when there's an overlap between the Asian and the London session, this can be the best time for you to trade, because that will be when there will be enough volatility, enough volume in the market. Okay? Welcome to day 21, and today's topic is different types of traders part 1, and today we'll focus on the first 2. There are different types of traders. I'll be talking about 6 different types of traders. The first 4 is the most common types of traders that many people are conversant with. Number one is scalper. Now, who is a scalper? Scalpers are short-term traders that focuses on holding position for time frame as small as few seconds to few minutes. That they hold position for maybe 15 minutes. They don't really hold positions for so long. Now, Forex scalping strategies involves trading frequently throughout the day with the intention of achieving small gains at the busiest or most liquid times. Scalpers live life in fast lane. They are continually faced with processing new information and reacting to rapid market changes. Okay, they are very, very observant, instinctive, and quick-witted. Okay, but the bad thing about being a scalper is that you are under pressure. Okay, you're under pressure. So scalpers just try to look for very little gains, but they take trades like they can take trade 10 times a day, 15 times a day. Maybe they take trade every 5 minutes, every 10 minutes, just to take small gains when the market is very, very liquid. Okay. Now, number two is day traders. Day traders are traders that execute frequent trades on an intraday time frame. Okay. While their routine will not be as fast paced as scalper, day traders they would similarly close all positions before the end of the trading day. They will close all positions before the end of the trading day. So once they put a trade up for today, by 5 p.m., if you're a Nigerian trader, once they start 8 a.m., by 5 p.m., they've closed all the trade. Whether the trade is going in their favor or not, they don't care. They will close it. Okay. So they don't want the trade to be affected by maybe negative news that can hit prices before the market opens the next day or after the market closes. All right. Welcome to day 22, and today's topic is type of traders part 2. So we'll be looking at swing traders and position traders. Swing traders can hold on to trades for longer than a single day and up to perhaps a couple of weeks. Okay, some people can hold trade for so long. As long as the trade gets to their desired take profit, then they are good to go. So over this short time frame, swing traders will typically favor technical analysis. They always try to use technical analysis over fundamental analysis. Although they still try to, get to hear the news and get to hear some important information that can trigger volatility. But what they try to do is use their chart patterns and technical analysis to take their trade and set their set profit. And once the trade gets to their take profit, even if it's going to get to their take profit in a couple of weeks, they do not mind. They could wait till it gets to the take profit and they close their trade. Okay. Number 4 is position traders. Position traders hold trades for longer periods of time, for several weeks to years. As the longest holding period among trading style, position traders are less interested in an asset's short-term price fluctuation, and they are more concerned naturally with the performance over more sustained time frame. So they are looking at a longer period of time. Apart from trading via CFD, now some people hold Bitcoin for a very, very long time. Very, very long time. When Bitcoin was around $10,000. Now Bitcoin is over $100,000. Over $100,000. What the position traders do is that they hold trades for longer periods of time, for several weeks to years. Okay. And they are more concerned with sustained time frame. As long as it gives them their desired results. Welcome to day 23, and today we're going to be talking about the types of traders part 3. So we're going to be looking at the remaining 2 types of traders: algorithmic traders and event-driven traders. Algorithmic traders rely on computer programs to place trades for them at the best possible prices. These are ones that use bots, trading bots and all of that. So traders can use defined instruction or high frequency trading algorithms to either code the programs themselves or purchase existing products. They can buy products that tell them when to go into trades. Okay. This type of trading suits people who are comfortable with using technology and want to apply it in their Forex career. Okay. So that is algorithmic trader. Then event-driven trader. Event-driven traders are traders that look at fundamental analysis over technical analysis. These ones, they always like to watch world news and know what is happening. They do the analysis based on fundamental analysis, what is happening around the world. So they seek to take their trading decisions from fundamental analysis. They seek to benefit from spikes caused by political or economic events such as the NFP, the non-farm payroll data, the GDP, the employment figures, and elections. So this type of trading will suit a person who likes to keep up with world news and who will understand how events can impact the forex market. That's about different types of traders that I will be sharing with you today. Welcome to day 24, and today's topic is:
What is a candlestick? Some call it Japanese candlestick. In fact, it's called Japanese candlestick. A candlestick is a type of price chart used in technical analysis that displays the high, low, open, and closing price of a security for a specific period of time. It could be 30 minutes, 1 hour time frame, 4 hours time frame, a day. It could be a week, a specific period of time. Now we have bullish and bearish candlesticks. Bullish candlestick opens below, and you can see it closes above it. It closes above. Opens below and closes above. What of a bearish candlestick? It opens above and closes below. Now, this place that is written high or low is like the highest and the lowest points they went throughout that specific period. Now, I would explain it further. Looking at this picture, this image, this stock chart now is a bullish candlestick. The opening price was 90. It opened at 90 and it closed at 100. Can you see? It opened below and closed above the price. Now, the candlestick fluctuates just like how the market fluctuates. So that's why they have high and low. Now, it opened at 90. At some point, it went low to 86. And at some point, it still went very high to 112. But after the high and the low, it closed at 100. Opened at 90, went low, 86, went high, 112, and then finally closed at 100. So that is what we call high, close, open, and low.
Welcome to day 25, and today we're going to be talking about technical analysis. Technical analysis. Technical analysis is the study of historical price action in order to identify patterns and determine probability of future movement in the market. You do this through the use of technical studies, technical indicators, and other analysis tools. Now, technical analysis just boils down to two things: identifying support and resistance, and identifying the trend through the price chart. Okay? So when traders talk about technical analysis, it simply means that they're studying price movement, past price movement, to guess where the price might go to next. That's exactly what traders do in Forex. They look at charts, trends, support and resistance to predict future price movements based on past behavior. Okay? Welcome to day 26, and today we'll be talking about support and resistance. Support and resistance are specific key levels or zones in the trading chart where the price of a forex pair is likely to find opposition. Okay, I will still explain further. Support is an area on the chart that price has dropped to but struggles to break below.
Like in an uptrend?
The price has reached support. It has struggled to break through that zone. So what happens? It goes back up. In a support scenario, when it gets to support, the buyers will overcome the sellers. So this will now increase the price. The price will no longer fall again. It will now start moving up towards resistance level. So what is resistance? Resistance is an area on the chart that price has risen to,
but it has struggled to break through above. It has struggled to break above that price. This is where whenever it gets to that top, it will struggle to break through. It will come down. Resistance is that area, and when price reaches that area, it will now bounce back again down. So resistance is that price level at which supply is very strong. So when price successfully passes through a resistance, that resistance now automatically becomes a potential support, and vice versa.
Welcome to day 27, and today's topic is trending markets and trend lines.
A trending market is a market that trends in one direction or another. Okay. Now we have the bull market trend, that's uptrend, when the trend is moving upwards. And we have the bearish market, that's when there is a trend and the trend is moving downwards. Okay. So what is a trend line? Now, a trend line is probably the most common form of technical analysis in Forex trading. A trend line is simply a sloping line in which price either has trouble rising above or sinking below. It's much like the support and resistance levels that I showed you. I already explained earlier in the previous class, but this time it is drawn at an angle. So this is an example of an uptrend. An uptrend is an upward movement or a bullish trend. Okay, an uptrend consists of higher high and higher low. The market fluctuates, so it moves in like a zigzag pattern. Okay, so when you want to identify an uptrend, you have to see a higher high and a higher low, just as you're seeing in this picture showing up now. And same thing applies to a downtrend. A downtrend is downward movement, is a bearish trend, and it has lower high and lower low. Lower high and lower low. Okay?
Welcome to day 28, and today we'll be talking about fundamental analysis.
Fundamental analysis. Now, fundamental analysis involves the assessing the economic well-being of a country and by extension its currency. Okay, it does not take into account currency price movements. Rather, fundamental forex traders use fundamental analysis as data points to determine the strength of a particular currency. Okay, a fundamental forex trader, that's an event-driven trader that trades the news, will analyze the country's inflation, trade balance, GDP, growth in jobs, and even their central bank's benchmark interest rate. Okay, so in this picture that you're seeing now, this is an example of an economic calendar where fundamental traders will be able to keep up to date with the latest data releases. Okay, now there are many data releases on any given day, which is why traders should know how to filter the calendar to show relevant information only. Okay, also, by assessing the relative trend of this and other data points, a trader is analyzing the relative health of the country's economy and whether to trade the future movement of that country's currency. All fundamental analysis help you does that. In essence, a good economy, has higher currency value and vice versa.
Welcome to day 29, and today's topic is risk management.
Risk management. Risk management is a key element of forex trading. It's better to understand these simple facts now than later, and then put more efforts into mastering risk management. Okay? Now, what is risk management? Risk management is the identification, analysis, assessment, control, and avoidance of unacceptable risks. Avoidance, minimization, or even elimination of unacceptable risks. Okay? Now, the risks that exist for forex traders is simple to understand. If you place a bad trade, you close with a loss. Okay? It's as simple as that. So now, ordinarily, a trader can't control the price movement, okay, and can't be 100% sure
of the result of his or her trade. However, it's possible to control many other things. What are these other things? Like when to trade, when not to trade, what to trade, when to exit a trade, how big a position to open, when to open an order. Okay? So you can know the worst case scenario. If you have safety mechanism in place, you can know the worst case scenario. And this helps you to mitigate your risks. All right? For example, if you have a stop loss order, you know that you know that your maximal loss on this trade won't exceed the size of your stop loss. That's why I always say always use a stop loss. Okay? It means that you shouldn't worry about losing, and you can concentrate on the winning. Now, when you place a trade, probably you place a trade and your stop loss is like, if it goes against, if it doesn't go in your favor, you lose about $5. But if it goes in your favor, you gain about $20 or $15. That's like a very good trade. 1:3 or 1:4 risk reward ratio. Now, you shouldn't be worried. Like, you have a relaxed mind, because worst comes to worst, you lose $5. But if it does win, you gain $20. Use a stop loss. Don't say, I know what I'm doing, I don't want to use. You will blow up your account. So always use a stop loss. All right?
Here are some of the ways you can be profitable using risk management. Number 1, be a controlled trader. Number 2, position sizing. Number 3, risk reward ratio. Number 4, diversify. And number 5, follow your trading plan. Welcome to day 30, and today's topic is trading strategy.
How to create your own profitable trading strategy. Experienced traders rely on the thoroughly elaborated trading strategies. Okay? They know that although there might be some deviations in the exchange rate, they do actually follow some particular pattern. So it's very, very necessary to have a strategic approach to trading. That's why we encourage you to build your own trading strategy. All right? Have a profitable trading strategy. Now, what is the benefit of having a trading strategy? A trading strategy is a set of rules that helps the trader to avoid the destructive emotions during trading. A strategy can be back tested on the historical data, so you have proof that it can really work. You can check it on the historical data, you can check it on pairs, you can demo account, and also you have proof that this is working. I've tried it times and times and times and it worked. So that's the strategy. And a strategy reduces the time of the market analysis. As soon as the strategy provides the signal, the trader start acting. Okay? Steps to build your own trading strategy.
Number 1, know the type of trader that you are. Number 2, know the market conditions you want to focus on. Number 3, choose your tools. Number 4, define the setup and have an entry and exit rule of your strategy. Okay? Number 5, set a strict risk management rule and stick to it. Number 6, test your strategy on a demo account. And number 7, start using your strategy on a live account. Okay? So your trading strategy is what connects the dots for you in Forex, all right? It is your personal game plan that helps you to trade with confidence and consistency. Congratulations on making it to the very end. I know you must have watched this entire guide, and this will build a solid foundation for you in your trading. I know that now you must have fully understood the core concept that every beginner needs before placing trades. So if you're looking for a structured beginner program, I have created the Forex Made Easy course, where I walk you through Forex step by step in an organized learning experience. However, if you are serious about becoming a consistent, profitable trader, I would actually recommend getting my TEPS course. This is the Trading Edge Profitable Strategy course. Why? Because this TEPS course already includes the complete Forex Made Easy course plus all of its bonuses, so you do not miss out on the basics. And on top of that, you will learn my complete trading strategy, how I identify high probability setups, my risk management framework, trade execution process, and the rules that has helped me become a more disciplined and consistent trader. Most importantly, I have shared my Rejoice Muna strategy
in the TEPS course. If you're ready to take the next step, click the link in the description to join the TEPS course. And if this video has helped you, please don't forget to like the video, subscribe to the channel, and share it with someone who wants to learn Forex the right way. Thank you so much for watching, and I will see you in class. Bye.